Hello, everyone. Welcome to Senioropedia, the everything how-to guide for seniors and caregivers. I'm Viraf Balawala, your host. Today we have with us Bruce Moir. He is a senior consultant with West Coast Actuaries. Bruce, welcome to the show.
Thank you, Viraf. It's a pleasure to be here with you this morning.
So tell me, we're going to talk today about individual pension plans, better known as IPPs. What exactly is that?
So an IPP, think of it as a supersized RSP. It's a pension plan that is set up, just by nature of its name, for an individual. I'll get a little technical here, and I'll try not to get into a lot of jargon, but just to set the table, so to speak, of people, government workers, teachers, employees of large corporations. A lot of them have what's called the defined benefit pension plan. The rest of us, we have our RSPs. That's a defined contribution type of retirement plan, right? We put a certain percentage of our salary in, and over time it grows, and some sort of a retirement income is paid out of that RSP, but we can't predict that amount. A defined benefit pension plan promises a specific amount of pension at your retirement age. So we as actuaries do some calculations for that individual. We know retirement age is, we use 65 for our calculation purposes. It can be as early as 50, as late as 71. 65 is what we use for calculations. And we know what that promised pension is at age 65, because that's baked into the Income Tax Act and pension legislation. And then we have a fixed rate of return assumption that we use on our pension fund as we calculate things. So the only variable in there is age. So if you think about it, I wave my hands a lot when I present. If we know the amount of money that it needs to be there at age 65, then the only variable, as I mentioned, is age. A 35-year-old with the rate of return assumption fixed, a 35-year-old has 30-year time horizon to save that pot of money at age 65. A 55-year-old has just a 10-year time horizon to save that same amount of money. So the IPP works really well for that older person. Much shorter time horizon, much bigger contributions have to go into the IPP. And that's the big benefit of the IPP. It's an opportunity for someone to save a lot more than they would with RSPs.
Okay, and I as an individual can put into an IPP, or is it more so for business owners or?
Very good question. You're exactly right. IPPs are set up by business owners and incorporated professionals, doctors, lawyers, people like that. And there's a couple of criteria that have to be met. Obviously, I mentioned the age factor. They start to work really well as you get into your 40s. So we're looking for people who are, let's say, 40 and up. They also have to be incorporated. So a sole proprietor or someone who is just an independent business person, it doesn't work. So you must be incorporated. And then the third factor is you need to be taking a salary from your corporation. Within pension legislation, things like dividends don't qualify as what we call pensionable earnings. It must be a salary. Those are the individuals. We're narrowing it down to a select group of people who would be looking at an IPP.
Okay, so as an individual, I can't really do anything about it unless I set up a company, incorporate it, and then start taking a salary out of it. But
That's
if I'm
correct.
already a business owner, let's say a doctor or whoever, then they are in a position because they don't really qualify for any sort of pension anyways, from other than a little bit of government pension, but they don't have a company pension. So you're saying that they can contribute more money through the business into this IPP. And then later on in life, that's when I can start drawing on it so that I can maintain my lifestyle, maintain the level of income that I want to have at that retirement age. Is that correct?
Yeah, exactly. And a retirement income that's very similar to what someone who's part of a government pension plan or a large corporate pension plan is receiving. Generally, when all the conditions are met, much better than with RSPs. The
Okay.
reality is, VRF, is the government here in Canada has taken away a lot of the tax breaks that you want for small businesses. Capital gains are now taxed at a certain level. Your passive income within your corporation is taxed at a much higher level once it reaches that certain threshold. You can't just have family members on the payroll and pay them large salaries. That option's gone. You can still deduct your car lease and your cell phone payments, and you can also contribute to an IPP. It's one of the last few benefits that's available for business owners.
Okay. So how soon? Because our last episode, we had one of our viewers who was asking about how do I maintain my standard of living after I retire? And so how close to retirement can this be done? And how can we use this to address that sort of question?
So the key to, like anything retirement, is this is not something you just figure out on a whim and start doing tomorrow. It's part of, it should be, I call IPPs part of business financial planning. Just like you're planning your own life into retirement, you've got to think about, what's the future of my business? Am I selling my business at retirement? Are my kids taking it over? Am I winding the business up? What does my retirement look like, and how can my business be part of that? So this is an exercise whereby that business owner, I'm going to refer to as business owners as opposed to plus incorporate professionals, that business owner needs to engage both their accountant and their trusted financial advisor in these discussions. We're then typically brought in as those discussions evolve to look at the IPP and see if the IPP makes sense. As I mentioned, it's something that you're starting to look at as you hit your 40s. So it's not something a 20-year-old is doing. There's not too many young 20-year-old business owners. You get in your 40s, that's probably when you're just really starting to hit your stride with your business. And then it's typically that person who's now hit 50, 55, let's say, business is doing quite well. They've been diligently saving with RSPs, but they're looking going, wow, my business has done great. I'm accumulating assets within the corporation. What else can I do? And that's typically starts a lot of times with a conversation with their accountant.
So the company pays me and I put it into my IPP, or the company puts it in directly? Is it a business expense?
Yeah, good question again. So yeah, this is a pension plan that's set up by your corporation, and the contributions are made by your corporation on your behalf. And those contributions are a deductible expense to your corporation. So it's a great way of moving money out of your company into personal ownership. That can have a factor later on, and we'll talk about it. I've got an example to share with you, but could be a great way to help facilitate the sale of a business, for instance.
How
I'll
would
explain
that
that.
help facilitate the sale?
So say you're thinking about retirement and you're thinking about selling your business, and I don't know, let's use a number. It's worth $2 million in your
Mhm.
mind. The purchaser might have a different idea. And I think that's typical of any sort of negotiation. And so if you've set up an IPP and made big contributions to the IPP over a number of years, the contributions into the IPP from the corporation will, depending on the right conditions, will definitely be in the high six figures. Could even be $1 million that you've put into the IPP over the years. So if you think about that in sort of terms of, you've moved $1 million out of your corporation into your personal ownership, into that personal IPP account, you could look at it when the sale time comes along and says, yeah, I think my business is worth two, but I've taken $1 million out of the business already. Maybe I'd be prepared to look at a somewhat lower price than $2 million.
I
Making
see.
sense? Yeah.
Yeah. So basically on your books, you're not really showing the same level of profit because you pulled all this money out and it's a business expense.
Yes.
However, when somebody is doing their homework to buy the business, their due diligence, then they'll probably exclude that amount or accrete that back into the revenue of the company to show that it's a much higher profitable entity.
Yes, exactly. That would be a good way of showing it. That's a great suggestion. And the reality is, as well, is on the sale of a business, that IPP is not going to stay on the books. The new owners do not want to take it on as a liability, obviously. So you'll take the steps to move that IPP out of the business as you also extract yourself from the business.
Does that go into an RSP or?
So there's a couple of different options. Say you've hit 65 VRF and you're done. You just want to sail off into the sunset, so to speak. You could
I prefer to just be on a beach.
even better. Yeah,
That's my goal.
exactly. So the IPP, again, we calculated what your pension income is at 65. You could start collecting your pension, receive a check every year. Obviously, I should point out, this is a tax deferral program, just like RSPs are. When you start drawing the money, it is taxed, ideally, hopefully at a slightly lower tax rate than you had pre-retirement. But so you could choose to start receiving the pension, the lifetime pension. The second option is you could, and use some jargon, the term is wind the plan up. So again, you're 65, you don't want the hassle of keeping the account open. You just want to shut this thing down. The IPP can be rolled into your RSP. Now that's going to depend on which province you reside. Here in Ontario, also in Quebec and a couple of other provinces, the money rolls directly into an RSP. In some of the other provinces, it might roll into a locked-in RSP, but it's still a lot more flexibility at retirement. So those are typically the two options that people select at retirement.
So do you have a couple of examples of how this would apply? Because once you start talking all these numbers and whatnot, I know it goes over my head and sometimes it goes over other people's heads as well. But maybe you could apply some examples from your experience and your clients that could help explain it to us laymen.
Yeah, as much as I can. There's a lot of jargon in IPPs. And I think as actuaries, we manage to help perpetuate that. Hopefully I can help with the interpretation and get it down so that we can all understand it in lay terms. So I'll tell you an example of Dr. Amin. She is an optometrist who's been thinking about retirement and winding down her practice. And one of the issues she has is she has an old house that's been converted into her practice. And that's owned within a professional corporation. So she decided to sell that house as part of her winding down exercise. She's able to lease the property back for a couple of years. She can, until she's ready to fully retire, or sell her list of clients to someone else, but the house doesn't need to be there. Problem is that house she bought it quite cheaply when she first set up her practice. That house has now attracted quite a large capital gain within her corporation. So we were brought in to help her see if we could help mitigate that big capital gain that occurred within her practice. So she's been practicing since she started practicing back in 1991. She's now in her 60s. She's built up a nice, significant RSP. We did all of our calculations, and she was able to. There's another nuance with IPPs that I haven't mentioned is we're able to backdate these plans. So when someone sets one up, we're not just looking at contributions for the year 2025. We can also go back to the date of incorporation for that individual. And we literally go back. Yeah. So it's a really cool feature. We go back each year by year. So we went back to 1991 and said, okay, how much pension should Dr. Amin have earned in 1991? How much money do we have to have in the plan in today's dollars? And we literally add up all of those years the term we use is past service. And in Dr. Amin's case, that past service cost or liability was just over $600,000. So $600,000 for buying back those years of service when she first got started and when she was incorporated. Added on to, for 2025, her contributions are just under $50,000. Remember I said the older you get, the higher the contributions, is quite favorable compared to the maximum RSP contribution for 2025 is just under $32,500. So she gets a significant bump at almost $50,000. So bottom line is we sheltered basically $650,000. She took $650,000 out of her corporation into this personal IPP, and that was a deductible expense for her corporation. We helped to reduce that liability or that tax bill that she attracted with the sale of her commercial property.
Okay, so the property was in the business's name from the get-go.
Yes.
Although she was also using it for her personal residence.
No, it was strictly just for her practice.
Just for the practice. Okay.
Yeah.
And over the years, it's gotten all this capital gains that had built up the equity. She's now able to sell it, take the capital gain, move it into her own personal IPP. It's a business expense, so they're not paying tax on it. So it's not just tax deferral, but it's tax savings.
Yes.
For the business.
Yeah. So tax savings for the business. And she just, with $650,000, she's just bumped up her retirement savings in a big way as well.
Exactly. And so that can maintain more years of having that level of pension income at a fixed level, I guess you're saying, because is it defined contribution?
It's defined benefit. So actually, so she'll have a six-figure pension that is actually indexed. It'll increase every year as well.
I'm assuming that's only dependent on the success of the investments that they make with that money.
Very good point. So as I mentioned, when we do our calculations, we assumed a set rate of return that is built into the pension legislation. The reality is that set rate of return, again, it's an arbitrary number. Markets could do better, markets could do worse. So one of the things that we do as actuaries, and we're required to do with an IPP, is every 3 years we do an audit, or we call it a triennial valuation, more jargon. We essentially look at the plan 3 years out and say, okay, how much pension has Dr. Amin promised? How much money is needed to be in the fund to fund that lifetime pension? And then we look and go, oh, what's the market value of the fund? Has it slipped below? Have we had a 2008 meltdown of the markets? In a scenario like that, we're going to say, gee, Dr. Amin, your fund has slipped below the level that's needed. You have to do a top up. And that's a top up that is, again, a fully deductible contribution to the business. If you think about it, and I'm going down a bit of a rabbit hole, but think about risk and investment risk. That exists everywhere.
Sure.
In anything you invest in. If the strong cash flow of your business is essentially able to top up your IPP account when markets drop, then you've just managed risk by using the strong cash flow from your business. It's a neat way of helping you sleep at night.
Yeah, I can see that.
It's obviously not something you can do with an RSP. An RSP loses $100,000 in 2008. That $100,000 is gone. You can't top up an RSP. You can try and invest your way out of it, but that's a bit of a mug's game as well. The IPP is a direct ability. If there's a shortfall, you have the option to put more money in.
So it sounds like with many things, there is a certain amount of risk, but through this sort of solution here, if you're a business owner or have a corporation that, whether it's passive or not, you can implement something like this, which will help secure your future.
Exactly.
And you don't have to worry about if it's only a couple of years before you're going to retirement, because as you said, you can go back in time as if you did it right from the beginning.
Yes.
Yeah.
I don't recommend doing an IPP, setting it up at the very last minute. There are a lot of considerations. There's planning around, again, your retirement.
We should all be looking at retirement planning because we're not going to live here forever.
Exactly. You know, what the IPP does is, especially a business owner, I don't care what business you're in, every year that you open your books and start off, there's uncertainty, right? Are you going to keep the customers you've had? Is some technology going to replace your business model? There's all kinds of risks. If you can at least take away that uncertainty with your retirement income, the IPP is buying you peace of mind. And for a business owner, that's a nice thing to know that, hey, I've got this piece of certainty in my life.
Okay. Do you have any other examples you want to share?
I guess just the other, I could add to Dr. Amin's story, another option, and I actually have good friends, they're dentists, and their daughter has joined the practice. She too has become a dentist. Takes the same numbers as Dr. Amin. She decides to retire and starts collecting her pension. Her daughter could join the business. And this is more of kind of a succession estate planning tool. I'm going to get a little more serious here. Dr. Amin decides to retire. Unfortunately, she passes away 5 years into her retirement. Obviously, we have no control over that. There's this pension asset sitting there that then has to be, on death, it's either going to go to her spouse or it's going to go to her beneficiaries. If she has no spouse, to her beneficiaries. So eventually it's going to go through her estate and get taxed. But if her child, her adult child, has joined the IPP and mom passes away, then we've lost one member of the plan, but there's another member in the plan who takes over that asset and there's no taxable event. So it could be sort of a estate and succession planning tool as well. The reality, Javira, is how many kids are taking over the family business.
Okay. Can we talk about the costs of doing something like this? I know it depends on the person and the business and things like that, but if there's some sort of framework for guidance.
So yeah, IPPs, you're hiring an actuary. We're not money managers. We're part of that kind of team that works with you, your accountant, your advisor. Our fee this year is just right around $1,700 to set up and get the plan registered. It's a flat fee. It's an annual fee. It covers, like, the triennial valuation is built into that, all of those things. It stays level. That's
a lot less than I expected you to say.
Okay, that's good news.
Yeah.
It is, and it's also deductible. It's considered a pension expense. So when your corporation sets it up, you're able to deduct that fee. But what I wanted to stress there when I talked about, so $1,700, again, Dr. Amin's case, she got to shelter $650,000 in the IPP. The cost benefit, I go $1,700 to shelter $650.
Yeah, no brainer.
She's getting good value for her actuarial dollar. I just did a calculation earlier today for someone who is in her very early 40s, and her calculation for contributions to the IPP actually worked out less than what she could put into an RSP. And so I cannot look somebody in the eye and say, gee, you should spend $1,700 to contribute such a tiny little amount. As you alluded, every situation is unique. And we want to make sure that when we do the calculations, that the person who is setting up the IPP is obviously helping to satisfy a need, and that we're providing good value for that dollar they're spending. Sure. I made the mistake years ago of talking to a business owner and saying, oh yeah, the cost is only this many thousands of dollars to set up the IPP. And he kind of looked at me, and I said, it's coming from your corporation. He says, yeah, fair enough, Bruce, but it's still coming out of one of my pockets.
Yeah.
And I've always remembered that, not to be too flip about people's money and their expenses.
Right. Now, you work for an organization called West Coast Actuaries. Does that mean that you really apply on West Coast, or you're throughout the country?
We are across the country, yes. We're able to, we have IPP clients all across the country. We just happen to have a Vancouver-based head office.
Anything else you'd like to share other than how to get a hold of you if there's any sort of questions? Because a lot of this kind of stuff will go above some people's heads. And as you said, you need to have an expert part of that accounting, financial planner, actuary team in order to do this.
Yeah. And yeah, that's exactly the point. Is we've just touched the surface. I've tried to keep it fairly high level. There are a lot of details and nuances to IPPs. Everybody's situation is unique. The easiest thing that we can do, and we'll provide my contact information, is talk to me. In a short conversation, I can get a sense of whether an IPP is going to work for someone or not. And then we have the ability to produce an illustration quite quickly. We gather some basic information, date of incorporation, date of birth, some salary history, a few other pieces of information, and we can generate an illustration that then I go back and I walk the person through and say, here's what these numbers mean. Here's the implications to you. Does it make sense for you? Perhaps let's engage your accountant next. The reality is, Vera, if you're setting up an IPP and you're looking to write a corporate check for $650,000, your accountant is going to be part of that conversation, right?
Yeah,
and
sure.
It should be.
All right. So how can people get a hold of you?
Two ways is good old-fashioned mobile, 647-766-2415, or I can be reached at bruce.moir@westcoast-actuaries, actuaries.com. Or you can find me on LinkedIn as well.
Bruce, thank you very much for all your insight and advice, and good luck with helping people with their IPPs.
Yeah, it's a lot of fun. I enjoy meeting people and trying to help them solve their problems. And thank you for the time today, Viraf.
If you like this episode, then subscribe, like, share, and most importantly, register for upcoming notifications at senioropediya.com.